Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate sponsors and syndication experts from every corner of the United States. We teach you how to harness the power of passive real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
What's up, guys? Welcome to today's episode of the Creating Wealth Podcast. I am your host, Kyle Curtin, and today I wanted to go over a couple questions to ponder, to run through your mind, to advise potential buyer clients, people potentially looking to get into the real estate industry as an investor for the first time. This episode will apply to a lot of different people. And this is something that I have been talking to a decent amount of people with, especially with some new clients that have been onboarding, very, very recently in Mass and New Hampshire. As well as, I was in a mastermind call today and I was actually kind of asked, some of these items that to consider. You know what I mean? For first-time investors, for, other agents to help advise their investor clients that are investing for the first time, etc. And this is what really kind of like brought about that conversation. And I'm like, damn, man, like I get a couple things right off the top of my head that I would like to share, and I figured it would kind of be a nice little short podcast to drop as well. So everything kind of lined up properly. So I have 4 things here, my friends, and 2 of them kind of link together. So in a way, it's kind of 3. But to jump right in, the first one to consider is your expectations for returns and being well-versed in running the numbers or potentially not running the numbers. And what I mean by that, right, is, for many people out there, jumping into their first house hack, you're definitely going to be running numbers on the property, hopefully have it make, it would be great if you could get a double digit, cash on cash return nowadays with where debt is at, and interest rates, in other words, it's a bit harder to do that. But anyway, so the reason why I bring this up is, many people out there would love to see like a 10% cash on cash, something higher. Other people might not be as dependent on the cash on cash. It's going to depend on the area. It's going to depend on, how many units are in that particular building. It depends on a lot of different factors, but that's not what I'm talking about today. The reason why I bring this topic up is because cash on cash may matter a ton to one individual, and it may not matter at all to another individual. And there is an individual in the middle as well. And that person being somebody who might be, currently renting. Maybe they're paying, $1,500 a month somewhere nearby. And, if they buy like a 3-family property, or even a 2, depending on, how you skin it in the area and that kind of thing, more than likely a 3 though. Their main priority may just be to drop down the monthly payment that comes out of their pocket as much as possible. And that's still an ultimate win, guys. This was something that was a learning curve for me a few years ago, the first time I had heard it, because you just kind of assume that, everybody wants, 10% cash on cash plus, like it's got to be double digits, or, like I won't take anything below like 9, you know what I mean? Like it's got to beat the stock market, like yada, yada, yada. Like, find me a good deal, and it's a very common conversation. But again, I want to stress this because, like I have somebody that mentioned to me recently, hey, I'm looking for a 2, 3, 4 family in New Hampshire. I just need it to break even. If it breaks even, that would be absolutely fantastic because of, a particular, scenario that this individual has. And cash on cash doesn't really matter as much to him. You know what I mean? Whereas other people, may just be chasing the return. and need to find something that's a lot more extensive as far as the project goes, you're going to be gravitating away from, major cities like Boston and Worcester, kind of going towards the outskirts of those markets to look for something that's more cash flow heavy, more of a cash flow heavy kind of market, compared to an appreciation type of market. And yeah, so that's something that I really wanted to stress is like, basically there's a spectrum when it comes to a good deal, quote unquote, because a good deal means a million different things to a million different people. Some people, it may be, 10% plus cash on cash return. Other people may be, hey, even if it cuts the amount of money that's coming out of my pocket for my housing expense every month. Whereas, somebody might be on one end of the spectrum versus the other. And it's different. It's going to be different for everybody. It's not necessarily, going to be the same thing as far as cash on cash goes, as far as, expectation goes. Like I said, some people might be okay if a property isn't even cash flowing. You know what I mean? But the money that's coming out of their pocket every month is going to be lower than it is in rent. As well as the qualitative reality that, they're throwing, now they're building equity with the amount of money that they do have to put into a building, that comes out of their pocket every month, rather than paying it to a landlord and putting equity in somebody else's pocket. Yeah, so that's a really big one, guys. Just make sure you have that conversation, whether it's with yourself, whether it's with a business partner, whether it's with your clients, regardless of, I think it's great to have anyway, even if they've invested before, just get on the same page, figure out what the heck is going on. This is one of those questions that I feel like is incredibly important and can both save a lot of time for both you and your client, or, yourself and your agent, or whatever your situation is. And it can also waste a lot of time if that conversation isn't had. Because like you could be on a million different sides of the spectrum and, still not really be looking for the same thing and not be aligned as the other person that you're working with. So I love to have that conversation in particular with people. The next one is kind of along a similar vein. It's if people are just kind of figuring things out and dabbling in the real estate investment space for what they want to do, whether it's flips, whether it's multis, whether it's house hacks, whether it's, just buying rentals as is, with 20% down, or, just as rental properties, whether it's short-term rental, whether it's medium-term rental, there's 1.5 million different things in our industry now, you know what I mean? And somebody from the outside in may see a lot of these different shiny objects, if you will. And I don't say that in a bad way. There's just so many different flavors of this industry that work incredibly freaking well. But that's the problem, is it's ridiculously easy to get overwhelmed because there is so many different freaking options and half of them look insanely cool. You know what I mean? Something to keep in mind along that vein is how much time you have, and how much time that you're looking to put towards a project. And this goes the same for house hackers too. But basically my thing here, guys, this is another conversation that's incredibly important, is how much time. So, I mean, if somebody is, maybe like a high net worth or a high earner rather, maybe they're like a physician, or like, work 50 hours a week. Maybe they have a few kids. Maybe they have, maybe like the kids of sports, maybe like, life, you know what I mean? And in general, you know what I mean? And maybe, that person may not have a whole ton of time, to be working on a project themselves. You know what I mean? That's a conversation that needs to be had up front prior to doing anything. Is it might not even make sense for you to buy, a multi, or like if you have no time and you're looking to do a flip yourself, I wouldn't even bother, and there's a lot of different ways to skin that in 1 million different directions, I mean, if you buy, a house hack and maybe you don't have a whole ton of time, but you're looking to cut down your living expense. Maybe, cash on cash isn't really something that means a lot to you. You want to buy something turnkey, as turnkey as you can find in your price point and that kind of thing. Something that doesn't really need work, but you're going to be buying it at or above market value. You know what I mean? So it's like, or, if you're maybe have a bit more time and, you're looking to house hack, maybe you could buy something that's a bit more beat up. Maybe a little bit of a project, maybe the units are kind of dated and that type of thing. And, maybe you have some time, to do some work yourself and that kind of thing. And maybe that's more of a fit, and maybe cash on cash means a bit more to you. So it's like, there's a lot of different ways to skin it. You know what I mean? The other alternative as well is partnering with somebody. And like, if you wanted to do a flip, but like, you don't have a ton of time, find somebody in our industry, that has done 1.5 million flips, build a very good relationship with them, essentially date them for a while and, figure out if you guys could potentially be a mesh together. And this one I can't really speak to yet because I haven't like officially like closed on something with a partner yet. So still kind of figuring that out myself. But that could be your way out. You know what I mean? If like, maybe both of you guys put up a reasonable amount of money, maybe like, equity and ownership percentages are, you figure out a happy medium between the two of you based on the amount of capital injected into the project from each of you. But the other person is the one that's, asset managing the project and making sure everything's going well and like, managing contractors and that type of thing while you're at work and you follow up after or whatever the situation is, So that's another conversation to have is how much time you have. And I mean, how much capital is another one too that could really, kind of add into this equation. But how much time is a very important conversation to have because I feel like that can dictate a ton. Because what you don't want is to like basically realize that you don't have pretty much any time after you've already closed on a project and it's like shit, like now what do I do? You know what I mean? And again, I mean, this was basically just a very basically an introduction to this kind of conversation. Like I didn't want to go too deep in any one of these topics in particular, so to say, in this little episode, but I still wanted to talk about them. And lastly, that is if you're I'm sorry, the third one, buying for cash flow or buying for equity. And this comes down to your markets. I mean, like I said earlier, like if you're buying in anywhere near Boston, do not expect like any sort of reasonable cash on cash return compared to like Leominster. You know what I mean? Because Boston's appreciation has been through the friggin' nose for a long time now. So if you're buying, anywhere remotely close to to that city and some very, decent surrounding areas to that, decently close. Buying for cash flow is going to be insanely difficult and borderline impossible for that, unless you're waiting an insanely long time where you've built a ton of equity, paid down a very good amount of debt, and then you'll probably start to cash flow eventually. Rents keep going up, fixed debt keeps going down. So, you might get that there. But, or if you're on the other side of the coin, and you're more for cash flow and you don't really care as much about appreciation, head to Central and Western Mass, and there are a lot of those tertiary kind of markets. And that's something that, a buddy and myself are looking in right now. Is some of these markets that are decently outside of, some of these cities, like even past like Leominster West, like Athol and Gardner and that kind of thing. And even further, you're not going to see appreciation out there, like steadily high appreciation, like you would, getting a bit more inward and closer to some of those main markets. But rents are probably going to be decent. And, it might be more of a cash flow play. What I find with a lot of investors, myself included, is I like a nice blend between the two of them. Although it kind of switches occasionally. I'm definitely more on the equity, play type of side at the moment, because, the time comes where like you have a property, you have a couple properties, and you have trapped equity. And it's like, shit, like, how do I keep playing the game? Like, now I need another 50K outside of a home equity line that's at 10%, and probably doesn't make sense for you to cash out refi if you bought 3 years ago. So it's like, yeah, that's another very important question is, which are you more bullish on today? Because that could change tomorrow. But it's going to depend on, the type of markets that you go out to, that you start looking for properties in, the ease versus the difficulty of finding particular properties that fit that type of dynamic within those markets. Like I said, trying to find something that cash flows high in Boston, good freaking luck. But, something that cash flows in Leominster, Fitchburg, Gardner, okay, that's probably going to be a bit easier to find out there. Much easier to find out there. So keep that in mind as well. Last but not least, number 4, my friends, is, are you looking to self-manage, or are you planning on handing it off to a property manager? Or if you're doing like a flip or something, maybe like a GC or like a, project manager of some sort, partner, whatever that looks like, that's the other really big one is, are you planning to self-manage? Because I mean, that could be, a difference of 10% of your gross rents a month between 8 and 10-ish, that is an extra line item on your expense column, or are you looking to self-manage? If, in my opinion, guys, if you're looking to house hack, especially for the first time, you're going to want to self-manage that thing yourself. Because you want to hold on to as much cash as you can, keep it in your pocket, do your rent increases, turn your units, get the gross income coming in as high, as close to where market should be. Again, within reason, don't do anything crazy. I'll leave that there, but you want to stabilize that property as fast as you can within reason, depending on the particular situation that you're in with your tenants and that kind of thing. Bigger reason for that question is, if you self-manage, you need to know, or if you are planning on having a property manager take care of it, along with, throwing between 9 to 11-ish% of your gross income every month to a company that manages that asset for you, you're going to want to know how that thing's run and what a day-to-day looks like. Because if you don't, like, there might be things that are happening. I've heard stories on podcasts and stuff of like property management companies like skimming money and that kind of thing because the owners have no flipping idea. And just doing like a lot of crazy shit. You know what I mean? That, somebody who doesn't have a knowledge of that type of thing, you might potentially fall victim to that, and it's, I couldn't tell you personally, like, if that's like a rare thing or a relatively common thing. I don't know, because I self-manage as well. So yeah, but something to keep in mind, you know what I mean? And yeah, it's because that's a really big one, again, throwing that back into, the expectations for returns. If you're buying a 3-family and you're, planning to self-manage it, you're probably going to keep a lot more money. Well, I should say you're going to keep between 8 and 10% in your pocket every month. But again, you have those responsibilities, and like, you'll have your tenants' phone numbers, and, it'll be reliant on you to have your vendors in the area, like your plumbers, electricians, plow people, if you're, if snow is in your area, etc. It's all going to be your responsibility, But if that doesn't bother you, and I highly recommend doing it this way for as long as you physically can, do that. Try to just stack money, and, if possible, and go from there, But yeah, that's pretty much it for today, guys. I'm curious if you guys have any more questions. Like I said, this was just like super high level, 4 immediate questions that, I like to talk about with pretty much anybody, that's looking to invest, regardless of if it's the first property or, a few properties in, because these are important, and it's not necessarily a set of questions that's as commonly talked about as it should be. And it's typically things that you find out after you close and maybe get like a month or a couple months in that, oh shit, like I don't have a ton of time, or, whatever the case may be, maybe you end up using a good amount of capital on that, the down payment and the closing costs and whatever, that now you don't really have a ton and have to be incredibly careful with using that money in the right place in the property and not selling yourself short. You know what I mean? And you need to be able to account for like random ass CapEx events that come up. I've had like the basement flood now because the water heater freaking blew out on me. I've had a furnace die out on me because it was a cracked heat exchanger, and it's a miracle that nothing came about from that. Things just happen, you know what I mean, guys? Like, hopefully your tenants are great. Like your tenants might randomly stop paying you, or like you butt heads, or there's 1.5 million different things, but this is just a little conversation to kind of get you started and to kind of start to think about some of these items prior to being in a situation where it might come as a unexpected surprise to you, and you might not have thought of that before. So that's pretty much it for now, my friends. If this was helpful to you, please leave a rating and a review on the show. It would mean a lot. Just trying to spread this, this advice to as many investors and people looking to get into the game as possible, and have some fun, But yeah, if you guys, have any questions or anything, feel free to reach out to me. I'm on Facebook. Jump in the Creating Wealth Together Facebook group. I'd love to see you in there and chat it up. And take it easy, my friends. Have a good day. Bye.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs. Get access to our private investor portal and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.